Is everyone seeing it?
Yes, you're fine.
Yes, you're fine, Sholla.
So everyone can see my screen? Great. Okay, so we'll start with, I'll present what we're going, with the content of this presentation. It's so about understanding the financial reporting, the typical financial reports that are used, and what kind of information we get from financial reports, why analyzing and assessing financial reports is important. Also, I have included some examples where we can see from practice what is like good financial health and what is not so good financial health. And also I have included at the end the digital transformation of the accounting as a profession. This is important also for people that are accountants, but also for businesses that seek to transform the accounting system. Okay, so let's start with the financial reporting. Here we have the basic financial reports that are mostly used, and also like a definition of what is financial reporting. As you can see, financial reporting involves collecting, analyzing, and presenting financial data in a structured and standardized format. To explain this more in simple terms, this means that all the transactions of the business or the company needs to be recorded, and then this information is structured and all the accounts are consolidated in a certain financial report. The most important financial reports that are used are the balance sheet, income statement, statement of cash flows, and statement of changes in equity. We'll go through each of these and see what kind of information we can get from, for example, balance sheet or income statement and so on. So we'll start with the balance sheet. The balance sheet provides information about the company's assets and liabilities and also equity, but in a specific date. So, for example, usually a balance sheet is prepared for a one-year period, and this depends on the fiscal year. Some countries have the calendar year, same as the fiscal year, and the balance sheet provides information for specific accounts, for example, on 31 December of a particular year. The information that we can get from the balance sheet are related to the assets that the company has in its ownership, the obligations that it has towards other parties, and also what is the remaining value of this difference. This is important specifically for shareholders, which means that what is the value that remains for shareholders after the company has paid all its liabilities. Is it clear until now? Do you have any question? Okay, so here I have divided some information that we can get from the balance sheet. First, when we check one balance sheet, we can say how much that the company has related to the equity. This is just what we said. So basically, what the company, all the assets of the company, then we use these assets to pay all the liabilities, and then what is left is the company's equity. Another information that we get from the balance sheet is how liquid the business is in the short terms. We will see that we have various indicators that can measure this. But when we say the short term, we mean assets that can be turned into money in a period that is less than 1 year. This is specifically important to meet also the short-term liabilities. Another important information that we can get from the balance sheet is what percentage of assets and tangible assets comes from the financial transaction. Excuse me?
No, go ahead. Go ahead.
Yeah, okay. Okay, so here the assets means like the objects, the machinery, the land, and everything that can be like touched. And this is different from the financial assets, which means that they are related to shares, to bonds, and so on. Okay, and another information is how long it takes to receive outstanding payments from customers and to repay suppliers. Okay, so this is related to, maybe you have heard about accounts payable and accounts receivable. Accounts receivable are the money that the business is going to accept from customers, while accounts payable are related to the obligations and other liabilities that we have towards suppliers or other business partners. And lastly, from the balance sheet, we can understand how long it takes to sell inventory the business keeps on hand. This can be measured from what is called inventory turnover, which is it measures this time until the inventory becomes like a liquid assets or money in short term, yeah. Okay, before we continue to income statement, do you have any questions or something to add related to the balance sheet?
Go ahead.
Yeah, okay.
Sholla, your question?
Good afternoon. Thank you very much. Okay, so my question is, can income statement be prepared from net revenue?
Excuse me, I didn't hear you well. Can you please repeat it?
The income statement.
Yes.
Can it be prepared from using net revenue?
Well, all financial reports, I would say that all are related to one another. And for example, information that we get from the cash flow, the ending balance from the cash flow is transferred to the balance sheet as a state of account. While the income statement, we use the revenues and the cost to see how the company has operated within a given period of time. I'm not sure whether I understood your question well, but yeah.
You did.
Yeah, thank you.
Thank you.
And so we'll go with the income statement, which is also a very important financial statement, which provides information how did the company perform during, for example, 1 year. But it can also be prepared for 6 months or 3 months, depending on the need for this financial report. So basically, it includes the revenues, the expenses, the net income or loss over a specific period of time. We will see with one example for how the income statement is structured. And here I will add that another important information from the income statement is the gross profit. So gross profit is the revenues deducted from when we deduct the cost of goods sold. This is important for the companies that are like not very not, I would say, retail companies, especially where they can see the cost of goods, because then from the gross profit we have the space or the amounts that we can use to cover all expenses. So this is crucial information for one company. So what is the information that we get from the income statement? We can know how much is the revenue over a certain period of time. We can know the gross profit, which is what I just mentioned for the goods sold. We know what the percentage of revenue results in net profit after expenses. So why is this important? Because it says that how efficiently the company manages to generate revenue while still operating with profit. So another information is if the business can cover its interest repayments on debt. Some companies use EBITDA. I don't know whether you heard of it. It's earning before the interest, taxes, depreciation, and amortization. This is yeah, it's very, very important, and usually the companies always are interested also to cover the interest repayments, especially when they rely quite much on loans and other debts. Also, how much the business repays to shareholders versus how much it reinvests. We know that this net income, net revenue, is something that the company either can reinvest or can repay the shareholders. This decision, of course, depends on the nature of the business, of the strategy, whether the strategy is, for example, to reinvest in research and development, or to pay shareholders, or to invest in expanding the business, and so on. Okay, before we go to the statement of cash flow, do you have any questions or something that you would like to discuss more about the income statement?
Yeah.
Okay.
Hi.
Hi.
Yeah, this Ivy. I want to know first profit and net profit.
So the question is for the net income, the net result?
Yes, gross.
Yeah, okay. And net profit, yes, okay. So the gross profit is basically the revenues when we deduct the cost of goods sold. This is the gross profit. And usually it's the third line on the income statement. While the net profit is what is left when every cost is included, also depreciation, amortization, interest payments, and that is like the net profit.
Oh, okay.
And usually it's the last line on the this financial report.
Thank you.
You're welcome. Another question? Okay, so I will continue with the statement of cash flow, which is a financial statement that shows the inflows and the outflows of cash or cash equivalents. This is cash equivalents are basically something that is very similar to cash, or that can be converted to cash very easily. Also, the cash flow statement is prepared for like a specific period of time, usually for one time or 1 year or 6 months, 3 months, and so on. It includes three main parts, which are operating activities, investing activities, and financing activities. These are the main parts of the cash flow statement. And for example, operating activities are all related to operational or everyday activities of the business, like paying accounts payable, or receiving money from accounts receivable, or paying the salaries, and so on. So these are like daily operational activities of the business. And then we have investing activities, which are like buying a new object or buying a new machinery for production, or investing in lands. These are all investing activities, and they depend on the strategy and also what kind of business we are dealing with. For example, if we are talking about business that is related to technology, then we can expect that they invest very much in research and development. But if we are talking about, for example, businesses that are related to the real estate, then we can expect that they invest more in lands and apartments and houses comparing to research and development. Okay, so we have here the main information that we get from the cash flow statement. We know based on information, or when we see, because I forgot to mention that financial reports are prepared in such a way that every user can understand them. Yeah.
Sorry, I keep testing my audio.
Okay.
It's still there, and an issue that I want to resolve until the presentation is off, and I
Okay.
work on this, and we start my system. Apologize for this.
Okay. I just wanted to add that I hear you only once. I don't have this issue with hearing you.
You don't have any.
No, I can hear you perfectly.
Okay, very good.
I don't know for other participants, but for me, it's okay. Yeah.
Continue your presentation, Sholla.
Okay. So the information that we get from the cash flow statement are related to how much the company is liquid, or how much it can meet its obligations. We also can see how the company ensures its cash, or the cash income, I would say, because the sources of cash may be from selling of the good, from selling bonds and shares, or from getting loans from banks. Another information is how much is the free cash flow of the company. So this free cash flow can be used for other operations of the business. And also we can check whether over a period of time the cash flow has increased or decreased. This is also like a signal or an indicator to see how the company is operating, and whether there are any like red flags that needs to be taken into account. Okay, so do you have any question about the statement of cash flow or something that you didn't understand until now?
I don't see any problem, so that's fine. Sholla, you may proceed.
We'll go to the statement of changes in equity, which is an important financial report, especially for the shareholders. Here we can see whether the shareholders took something from the company in form of equity or they invested in the company. So all these transactions are related to the changes in equity. And just as a reminder, this part is included in the balance sheet, which when we said that when the company has assets and also cash and all the other cash related accounts, then what is when all obligations are met, what is left is the equity of the shareholders. Okay, so here I have added one quote which says that from Warren Buffett, which says that accounting is the language of the business. And it makes sense because, of course, from what we just seen, we know that all the informations, all the transactions and the data of the company are collected and are presented in the form of financial statements. And these financial statements, as I mentioned, are prepared in a way that everyone can understand them. They are not complicated because they are prepared in such a way that investors, users, employees, and all can use them and can gather information based on these financial statements. So why are financial statements crucial in making business decisions? First, based on financial statements, we can evaluate financial health. How is this possible? It's possible to see whether the company or the business has the ability to generate profits, how it manages the cash flow, and how it manages to maintain a sustainable level of debt. This is particularly important because also when someone wants to invest in a business, first it will see whether it generates profit or whether it has a positive cash flow, but also mainly whether it has like a large percentage of the investment based on the debt. Another important topic related to the financial statements is that we can make informed decisions based on the informations that we get from financial statements. So what does this mean? This means that the financial statements are able to provide enough information so that we can analyze the financial goals and also the risk tolerance. So what is this risk tolerance? This is what I just mentioned. It is related to the percentage of debt, and also if the company, for example, is operating with negative cash flow over a period of time, then it is a red flag for the people who make decisions in one business. Or, for example, financial goals. We can set a goal that we want to increase revenues for like 5 or 6% on a yearly basis. And then we can check whether we have achieved this goal or not. Through the information that we provide with financial statements, we can attract investors because they will analyze the potential of the business and also the financial performance. They will check, so how they will see the financial performance. They will check the income statement, because the income statement is otherwise known as a financial performance statement. So they will check the cash flow, whether it's positive cash flow or negative cash flow, and then they will see the financial performance based on whether the company has generated net profit or not. And then they will see the balance sheet to check how much are the liabilities and how they can be covered or met by the active of the balance sheet, which is basically what the company has in its ownership. And also planning for the future, which most of the companies rely very much on. This is preparing some, like we have the traditional financial reports, and then, for example, we also have the budgeting and forecasting. This is particularly important to see whether what the company has forecast is actually in line with the real numbers or the real values that we get over 1 year or 6 months or 3 months. This is particularly important to see whether we have like expenses that are going below what is the plan or below the budget, or they are extending the budget. This is something that usually the financial controller section checks on monthly basis or twice a year or once a year. All this that we have mentioned until now can be divided in blocks of analysis. So we can analyze the liquidity, the profitability, solvency, and market prospects. The liquidity is related mostly with the balance sheet, where we said that we can get information on how fast the company can convert assets into cash, so it can meet the short-term liabilities or obligations. These are the short-term liabilities or obligations are related to the obligation that the company has to settle within 1 year or for a shorter period of time. Profitability is related to the income statement or the performance statement, and this shows whether the company is able to generate profit over a period of time. Solvency is similar to liquidity, but this is related to the long-term financial obligations, or the obligations that are longer than 1 year or 6 months and so on. And the market prospects here, these can be analyzed with goals, financial goals that the company settles. For example, the potential for growth and profitability. For example, the company can settle that the profitability for the next 5 years needs to be increased by this percentage in order for us to be able to gain a specific market or expand on a specific industry. Okay, now we go to the tools of analysis, and we will see some examples. The tools of analysis are horizontal analysis, vertical analysis, and ratio analysis. Here is an example of the first, horizontal analysis. And we can see that the company here is comparing several accounts or several positions between 2 years. This can be done also for a longer period of time, but 1 year has to be like a base year. In this example, the base year is 2021, and we can see that the revenues have increased for 20%. This is just an example for you to get a feeling what is the horizontal analysis. And we have here the income statement. So like we discussed previously, here we have the gross profit, which we can see is the difference between the revenues and the cost of goods sold. And then we have the net profit before the taxes. We go to the vertical analysis, and here is the same statement or the income statement, but here you can see that other positions, the next positions, are calculated or are presented as a percentage of the revenues. So we can say that 60% of the revenues has gone to cost of the goods sold, or 40% of the revenues is our gross profit, and all other operating expenses present 20% of the revenues. And then the net income before the taxes is 20% of the total revenues. Do you have any question related to horizontal and vertical analysis? Is it understandable?
Remember, ladies and gentlemen, I have the same issue on my end. On the chat, is the confirmation that you can but when anybody else picks up, then the echo is heard, which means it's certainly not on my end. We will relate that to our technology department. So don't expect me to say too much. But if you have questions, right at this time about either the horizontal or the vertical analysis, just raise your hand and let Behare Sholla know you need clarification. Thank you.
Yes. Thank you. Because I don't see the screen when someone raises the hand, so they may just turn on the microphone.
Okay, right at this time we have Lindo.
Yes.
Go ahead, Ava, with your question, please.
Hi. I'm just trying to find out how you get the percentage.
How the percentage was calculated? Did I get the question right?
Can you repeat the question, please?
Thank you. I was not on mute. Yes, that's the question. How would you calculate it?
Yes, thank you. Okay, so here, the 100%, we have put this percentage for the total revenues, which means that total revenues for us is this 100%. And then to see the cost of goods sold, we just have to calculate this as a percentage of the total revenues. This can be done by dividing the cost of goods sold with the total revenues, and then just adding the percentage.
All right, thank you.
All right, is this clear?
You may continue. Let's
I have another question.
go to emission. I am going slowly because echo is heard whenever somebody is speaking. So I'm not sure if our technology department is aware of that. And they are diligently working on this issue. It's not on my end because it happens when anybody else speaks, except for our presenter, Behare Sholla. So
I think
go Gatsy. Go ahead.
yeah, but I think that we have another question.
Yes, with Gatsy.
Yeah, hello everyone. Yeah, sorry. We have echo. I can't hear some of the questions from other people. But my question is, can you
I'm so sorry.
why they are called horizontal or something like that? I need to understand. I'm not really good in accounting stuff.
Okay, I can say that I heard you very well, but I think that your question is related to the horizontal and vertical analysis. You want me to go through it once again because you didn't understand it well, and is this your question?
Apparently, yes. Go ahead. We're not going to allow anybody else to speak. Because echo problem is overwhelming.
Okay, so I'll go through the example for the horizontal analysis. This is basically for the company to check how, for example, the revenues changed over a period of time. Here we are comparing 2021 with 2022, and we can see that it has increased, the revenues have increased for 20%. And this can be done for every position of the income statement, and not just for the income statement, but also for all the other financial statements. This is just an example to show you that how this is done and why. So basically, this is done to see the changes in every position over and comparing them between the years. As I said, we need to have like a base year, which in this example is 2021, but this can be done also for like 2020 or previous years. We just need to have a base year so that we can calculate the change. While the vertical analysis is for us to see how much or what is the percentage of each position in relation to the revenues. For example, we can say that the operating expenses represent 20% of the total revenues. Or we can say that the gross profit represents 40% of the total revenues. And we can see that all these, just a second, all these are presented as a percentage of the revenue. So the base to calculate these percentages are the revenues. This is our like a base number, to calculate these revenues. We haven't like presented net income before taxes to say as a percentage of cost of goods sold, because then it wouldn't be a vertical analysis. I hope that this answer helped you understand more the vertical and the horizontal analysis. Okay, I'll go through some indicators here because the ratio analysis, we have many ratios that can be used in accounting to analyze like every position that we need. But I have taken one example related to the return on equity. And here we have a balance sheet. We can see that until here, we have the active part of the balance sheet, which are the current assets and the total assets. Actually, it is until here. So we don't have like a long-term assets in this example, but if we would have like a long-term assets, then they would sum up with the current assets, and then we would have like total assets. And when we have current liabilities, we have long-term debt, we have shareholders' equity, net income, and dividends paid. The dividends are paid based on the decisions that the company makes, whether to reinvest the net income or to pay the stakeholders. So we have a return on equity, and it is calculated by dividing the net income and the shareholders' equity. And we can say that the company generated 19.2% return on the shareholders' equity. This is, I would say, quite a high percentage. So it is in favor of the stakeholders, which means that the company is managing the assets in efficient way. Okay, so here we go to the key indicators that can be used in order for us to be able to evaluate the company's financial health. And these are liquidity ratios, solvency ratios, profitability ratios, operating efficiency ratios, and cash flow ratios. I will not go through all of these because there are many, but I think that until now I have mentioned and we have discussed about each of them in particular. So based on what we have seen until now, I think that we are able to evaluate the financial health of the company. Okay, so here I have taken an example of the company that has good financial health, and it is Apple. Here we can see that the net income of Apple was $74.5 billion, while other indicators say that the net income margin over the past 5 years is 21%. Return on assets over the past 5 years is 16%, while the return on equity over the past 5 years is 52%. Well, this shows that the company not just has good net income, but also other indicators show that the overall financial health of Apple is good. So the return on equity indicates that the company is generating a significant amount of profit in relation to the amount of shareholders' equity that is invested in the business. Okay, So do you have any question, or we said that due to the quality?
Yes, I'm so sorry.
Yeah.
You can see I'm speaking slowly so that you can hear me, but the problem is too heavy. I have informed the participants that no questions will be allowed because of that issue. We cannot accommodate no alternative the echo. Thank you.
Thank you. Then I will continue just a brief explanation, because since here we are seeing just the numbers. From the information that we have from the financial reports of Apple, we see that the company has high revenues, high profitability, the return on assets, which is the measure of how efficiently the company is using its asset to generate profit, has been increasingly high. And the average over the past 5 years is 16%. This indicates that Apple is generating a strong return on investments in assets such as property, plant, equipment, or intangible assets such as trademarks, patents, and so on. So what can we learn from Apple is that it has an effective financial management. It has good strategies to manage cash flow, control costs, and optimize investments. All these informations are derived from financial reports. That's why I keep mentioning that analyzing and understanding financial reports is crucial for every business. And also another lesson is that Apple has a diversification of revenue streams, which means that they don't rely on a single product or service, but they have several products and services. And also accurate financial reporting. So why this is important? It's because the company provides understandable and clear financial statements from which we can evaluate the financial position of the company. And also this is very important for the investors, because they can trust this information that are provided, because they are clear and have high transparency. Sears Holding is another example of the company which does not have a good financial health, and then based on the information that we have here, we can see why. And I'm sure that you already heard about Sears Holding. So the company has recorded a decrease in revenues between 2012 and 2017 over 70%. The net loss for the financial statements ending at the end February 2020, they generated 2.9 billion of net losses, while the debt to equity ratio is over 7, which is very, very high. So what can we say? We say that Sears Holding had a declining revenues. This means that the company was losing customers, and also the sales were decreasing. And the high level debt indicates, and also I forgot to mention that this information can be derived from the balance sheet, and it indicates that the company has a high level of debt related to the equity, and this increases the financial risk. So what can we learn from this is that effective debt management is crucial. So we have to follow the red flags when we see them, and also financial transparency, because the investors have lost their trust in the financial reports that were provided from the shares holding, and also to monitor financial performance. Over the years, when declining revenues and consistent losses are a warning sign to monitor financial performance and to make or to change the strategy of the company. So based on what we said, we can give a conclusion that financial reports are a crucial tool for businesses to make informed decisions and to manage their financial health effectively. I will shortly go through this. Another important topic and timely topic is related to the digital transformation of the accounting. This is very important for both companies and also for the accounting as a profession. The good thing is that the principle of accounting are still the same. However, the way that we record and transform data has changed significantly. We have quick and reliable data processing softwares that have increasingly speeded the accounting process, but also it has provided opportunities to remodel financial procedures. So many companies have invested in transforming the accounting system and investing in the most up-to-date and fast financial softwares. I have here provided just some information about how the digital transformation is affecting the accountants and also the companies that provide accounting services. So this is a survey that was conducted by PwC, which is like a audit company in the group of the four the biggest companies that are providing audit and accounting services. So in their survey, they interviewed finance executive to know from near how they approached this transition process, I would say. And 33% of the respondents said that the digitalization has a very high impact on their finance function. 60% of the respondents said that their finance function has implemented advanced analytics. So this means that they already, the majority already has embraced this transition process to transforming their accounting and finances. So this means that the digitalization in finance is increasing efficiency, is improving accuracy and the quality of the data. These are all very important to improve the decision making. However, this process also includes some challenges, which are automation, cybersecurity, integration, and skill gap. While this process is like for the benefit of decision making, it also is costly because it means that the companies have to invest in new systems while they have to take care of the cybersecurity of their data and also the integration. This means that they have to integrate the system in their company, which may challenge the skills of the accountants. So they have to be like up to date and to be involved in the process of this technological transformation all the time. So what were the main points of this topic that we discussed today? We discussed that the financial information is crucial to make informed decisions in the business, to evaluate the financial performance, to forecast future performance, and to identify areas of improvement. So these are the main parts that we need to consider in order to have a good financial health of a business. And as importantly, also the digitalization in accounting is very important and is something that the companies are investing very much, and it's, I would say, the future of the accounting, because it provides more efficiency, accuracy, or flexibility. And it also, I will just take an example. Some companies provide like cloud accounting, which means that everyone can have access to the accounting information and not necessarily be physically there or do the accounting job in a traditional way. So also this digitalization is also related to adapting new technologies and processes, but without forgetting to update the skills. So thank you very much for your attendance today. And if you have any questions related to this presentation, of course, you can contact me on my email address, and I would be happy to provide answers or anything related to the accounting that might interest you.
Thank you.
Thank you
Very much. It's only unfortunate. I am communicating this last point very so that everybody can hear me. We have experienced this echo throughout today's live section, which make it impossible for us to accommodate questions. I sincerely apologize to each and every one of you, cherished friends. I thank you for joining. We have shared the problem with our technology department, and we are hopeful that by tomorrow this issue will be gone, and never ever will we have that problem again. Thank you very much.
Thank you too. And in the direct messages,
remember, ladies and gentlemen, the entire presentation will be made available with the link which will be sent to your inbox or within your student Behare Sholla has been outstanding, and we are thankful to her for also sharing with us her email account, Behare Sholla at gmail.com. So for questions which you have not been able to ask her during this live session, you are authorized to send her your question by email.
Yes.
And since there is no echo on your end, Sholla, please go ahead at this time with your last word and conclusion. Go ahead, please.
I'm sorry, I heard you with interruptions. I didn't catch the last part.
Okay. Sorry for your conclusion.
Okay. So as a conclusion, I would say that we have touched a few important topics related to the financial reporting, and this information will be valuable, especially to the ones that for the first time had the chance to know more about the financial reports. And as a conclusion, I would say that the financial information is crucial and very important for every business, regardless of the industry where they operate or the market, because based on the decisions that are made from the information that we get from the financial statements, we can make decisions that can help the business thrive, or that can cause business problems which can lead also to the bankruptcy. This is my conclusion for this topic.
Thank you again very much.
Thank you too.